Attracting good employees is very difficult these days. So one of the common benefits that a lot of these publicly traded companies use is issuing companies stock as part of their compensation package. It gives you that sense of pride and ownership in the company you're working for. And if the stock does well, so do you. The value of your shares increases. However, it often leads to long-term financial planning challenges from an investment and tax perspective. So in this video, I'm going to look at one of the surprising benefits of stock market volatility that has actually helped one of our clients alleviate this concern exactly. And then we're going to talk about 3 ways to avoid this concentration risk in the future. But first, my name is Kevin Lau. I'm the host of the Planning for Retirement podcast, and I'm also the owner of Imagine Financial Security. We help individuals over 50 who have at least $1 million saved to maximize their retirement spending, minimize their lifetime tax bill, and worry less about the financial markets. If that describes you, make sure to subscribe to the channel. We put out weekly retirement-related content designed specifically for you, what I like to call PFR Nation. So today we're looking at one of our clients who's worked for Microsoft for many, many years, okay? But now he's approaching retirement, and they recently engaged our firm about 12 months ago to really help get him to the finish line, create that exit strategy, and ultimately fire their boss, so to speak. But the issue that's really keeping them up at night is illustrated on this single slide, in that he works for Microsoft, great company, but because of these restricted stock units that have been issued and invested over time on their balance sheet, Microsoft now represents almost basically 30% of their investment portfolio. So they have an investment portfolio of about $2.1 million, which is great. I mean, they're in their early 50s. And they're tracking, they're really on track to retire before the age of 60, which is phenomenal. But again, $650,000 is tied up in Microsoft stock. And you might say, oh, boo-hoo, poor them. But the plan looks solid for him to retire before the age of 60, unless something goes south with Microsoft, or perhaps Microsoft doesn't keep up with the market in the future. Okay, have you ever heard of Lehman Brothers or Enron or Washington Mutual or Bear Stearns or General Motors? I mean, the list goes on. If you were to go back and interview some of those rank and file employees 5 or even 10 years before their collapse and ask those employees, hey, are you worried about the future of the companies? I guarantee you less than 1% would have said yes. Okay. And it makes a ton of sense. I mean, there is a reason behavioral finance folks have dubbed the term familiarity bias as one of the big reasons for this over concentration in company stock, because they're familiar. They've worked for that company. Okay. So of course, if that company is issuing them stock and they feel good about the company they work for, they're going to want to hold on to those shares. They're not going to just go ahead and sell them. But this is exactly why you should have an objective third party to keep you in check. Okay. So again, now we're in this position where they're in their early 50s. They're let's say within a handful of years of retiring. Now this is beginning to keep them up at night, because in the beginning, maybe 10 or 15 years ago, it was not as much of a concern because they had the time horizon. If Microsoft took a little bit of a dive, which it did in 2008, 2009, just like all the tech companies did, they had time to let that stock recover. Whereas now they don't have that time on their side. Okay. So we need to solve this challenge. We need to figure out, okay, how are we going to reduce this concentration risk? Because yes, on one hand, we could just go out and blow out the whole position, sell the entire 650,000 or maybe trim it significantly, but there is going to be a significant tax consequence of doing so, in the amount of probably in the neighborhood of just over $350,000 of capital gains at the time I'm recording this. Okay, so there are significant unrealized gains within that $650,000 portfolio. Okay, so you might ask, what is concentration? Okay, so concentration from a financial planning definition perspective is anything over 5%. Okay, so if you have over 5% of your portfolio in one specific holding, one specific company, that's considered highly concentrated. Okay, but let's give them a bogey. Let's say, hey, you know what, Microsoft, great company, but let's say 10%. Let's say 10% Microsoft. We're still 20% overvalued. So he should have, if we were to target 10%, he should have closer to $210,000 in Microsoft, okay, which is significantly less than $650,000. But it is what it is. It helped them get to where they are now. Now we need to figure out, okay, how do we get them to the finish line of retirement? How do we allow them to have that peace of mind that they can not only retire, but sustain retirement for the duration of their life expectancy? Because it may, sound great in the service, okay, retire before 60, but if Microsoft takes a nosedive or maybe they underperform for a period of time, that will significantly impact their ability to retire. And it also, not only do we have this concentration in one specific company, but now we have this under concentration. We have this underweighting in some of the other asset classes that have opportunity for growth in the future. I've talked about this before in the podcast before, and even these whiteboard fireside chats is yes, the technology sector has been the lead dog for many, many years. Okay, but look at what's going on in 2025. We've got energy starting to pop. We've got industrials, with the manufacturing, that is starting to pop. We've got healthcare. Okay, we've got financial services. I mean, so many of these sectors, they are significantly underexposed in because of this high concentration in Microsoft, simply, overweighting their portfolio in the technology sector. Of course, we want to have technology in the portfolio. We believe that has a lot of opportunity for long-term growth, but it has volatility. It has uncertainty right now with everything going on with tariffs, with interest rates, with regulation. I mean, there's so much uncertainty in the technology space. That's why it has so much opportunity for growth, because there is so much uncertainty. But we also want to make sure we have other asset classes in the portfolio to not only reduce risk, but maximize rate of return per unit of risk that the client is taking. So one of the benefits, one of the surprise benefits of market volatility is we can potentially reevaluate this concentration. Okay, if we did this a couple of years ago, it didn't look as pretty. But if you look over the past year, look at Microsoft stock. Okay, minus 7.29%. I think that many of you may be surprised about this because you've heard about the Magnificent Seven in 2023, being sort of the darling, Microsoft was part of that, the darling run on the tech sector. Okay, but look at this one, minus 7.29%. You might be a little surprised that the tech sector as a whole over the last 12 months is positive. So the tech sector as a whole is positive just over 10%. So that's underperformance of 17% over the last 12 months. Obviously, we're looking at a very short time horizon, but this is exactly why we don't want to be super concentrated in one particular position. Because if we were just owning the tech sector, they would have had significantly higher performance than they had over the last 12 months because of that Microsoft stock essentially holding down their performance. Okay. But given that volatility, given this opportunity that Microsoft has a little bit of choppiness over the last 12 months, now we can reevaluate these positions because yes, many of the shares that were issued, on their balance sheet, that's 630,000, represent shares that were issued maybe 5, 10, or even 15 years ago. Whereas they also have stock units that were issued 12 months ago, or 18 months ago, or 24 months ago. Those are the positions that we want to reevaluate and potentially look at. So we went ahead and ran 3 scenarios. We called it conservative, moderate, and aggressive. And the blue graph, the blue bar there, represents the market value at the time we're recording this. So in these 3 scenarios that we ran, the most conservative option, essentially trimming, right around $90,000 of Microsoft stock. So get them from about $630,000 down to about $540. Okay, so not all the way down to that 10% goal, let's call it, of $210,000, but still significantly lower. So 90K, most conservative. And the capital gain realized here is this orange bar. Okay, we'll underline this one, and this represents about $10,000 of capital gains. Okay, or just under $10,000 of capital gains. And these are all long-term. We targeted the long-term capital gains because they do have more favorable tax treatment. And so the estimated tax liability on that one here is represented in this green bar. I'm going to highlight this. I'm going to underline that in red. But the tax liability, because of the, again, 15% capital gain rate, we'll call it around $1,500. Okay, is the tax impact. So yes, no one wants to pay more tax than they need to, but $1,500 is the price that they would have paid to essentially reduce their position from $630,000 to 540. Again, we're not all the way there. So this might be one of those things, if they choose that conservative option, this might be one of those things that we would reevaluate on an annual basis and continue to chop this off as the closer they get to retirement, getting down to, let's say, that 10% target. Okay, getting down to 5%, I think that might be a little overly optimistic. I think even getting down to 10% might be a little overly optimistic over the course of the next 5 or 6 years. But maybe down to 15 to 20% is a realistic goal that's also aligned with their tax, sort of their tax appetite, which most people, and them included, they don't want to pay any taxes. Okay, but at the end of the day, this also could be a huge risk for them, as they approach retirement and enter the next 20 to 30, 40 plus years, based on their potential life expectancy. So the moderate scenario here in this one, we liquidated about $141,000, okay, of Microsoft positions. And that would have resulted in a long-term capital gain of about, we'll call it 26K. And therefore, the estimated tax liability on that one would be, we'll call it around $4,000. That really gets their concentration, I think, down to about 20, maybe 22%. Okay, so that's pretty attractive right there. And then even that most aggressive scenario. So this one, we're trimming down 211,000. Okay, the estimated capital gain would be about 50K. And then therefore the estimated tax liability on this one, we'll round up and we'll call this about $8,000. So $8,000 could be the price they paid to trim their positions from all the way from about $649,000 or $650,000 all the way down to about $440,000. And this would just be the first year we did this. And each calendar year brings about a new, the tax situation resets. Okay, so this is something that we will absolutely be revisiting on an annual basis. And so we just propose these three things because, again, in our review this quarter, this is their top concern right now is the outlook for not necessarily Microsoft as a stock position, but the outlook of this concentrated position concern. Okay, so that close to 30% of their investment portfolio is tied up in this one specific stock, and that if that stock doesn't play out favorably in the long run, that will absolutely impact their ability to retire comfortably. Now, obviously, one of the things we looked at here was capital gain. So if you're looking at this and if you're watching this video and you're in this same situation, you really want to look at the long-term capital gains brackets, okay? Because depending on your taxable income, you could be pushed into the 20% bracket, but you also might have an opportunity down here in the 0% bracket. Maybe you're retired. Okay, so maybe you retired and now everything is vested, so everything's on your balance sheet that's vested, and all of a sudden your taxable income goes down to zero. Maybe you're not even claiming Social Security yet. Maybe you're gonna hold off and pause on Roth conversion. So maybe you're doing some distributions from your investment portfolio. So maybe you've got some taxable income from capital gains and maybe some interest income or qualified dividends. But maybe you try to fill up, and this is for married filing jointly. Maybe you try to fill up this taxable income bracket and potentially pay 0% in taxes. So this could be a way where you could begin trimming those positions and actually pay no tax on those capital gains. Okay. Now, more likely, depending on income goals and your income needs, more likely you're going to be in that 15% bracket, which is where they are. Their taxable income, this is their tax bracket from 2024, is about $414,000. So even that most aggressive scenario, which is realizing about $50,000 in additional tax, they're still going to be in this 15% bracket. So check that off. And but that's one thing you want to look at. They will be subject to the net interest income tax, which is essentially a surcharge for Medicare premium. So it's an additional 3.8% tax on that one. So their tax rate's going to be a little higher than 15% on that sale. But again, the benefit to them is a significant reduction in this single stock, and ultimately giving them more peace of mind, allowing them to sleep better at night, knowing that, hey, their retirement doesn't hinge on one stock doing well, okay? And ultimately improving the confidence to achieve the desired rate of return that they need to make their financial plan work. That's really what I'm about, is I want to make sure, that the clients are getting the desired rate of return we need to retire comfortably, to fire their boss, have financial independence, maximize their retirement spending, minimize their lifetime tax bill, and worry less about the markets. And then from there, we're going to create an annual process on this one to revisit this so we don't have this same problem 5 years from now. Okay. But what are some tips that you can think about to avoid going through the same boat? Maybe you're in this situation already. Maybe you have significant unrealized positions on your balance sheet that are in that company stock that you either currently work for or have once worked for. Okay. Or maybe you're just kind of getting started in a publicly traded company. Maybe you're just getting new RSUs or restricted stock units vested and you're like, oh, this is great. But now you're kind of thinking, you're seeing this video and you're like, hey, what if I'm in this position in 10 or 15 years? So having an annual process to review your newly vested positions, this would be my first recommendation at its core, and really just your overall position, not even just the ones that are vested, but even the ones that are not vested yet. Once they vest in your balance sheet, that's when it's taxed as ordinary income to you, okay? Then if you let it sit, then it becomes a capital gain. Whatever that price is when it vested, that fair market value, whatever it increases over time too, when you sell, then you're going to pay a capital gain on that one. And depending on how long you held that position, if you held it longer than 12 months, you would pay a long-term capital gain. If you held it then fewer than 12 months, then you would pay a short-term capital gain. When it vests, there's going to be minimal gains, okay, or most likely, okay, depending on how much appreciation happened when it actually was issued to you. But ultimately, what you could really think through is, hey, does it make sense to start liquidating some of these shares based on the price? Because maybe they were issued a couple of years ago, but maybe the stock price is down. So at Vest, you could go ahead and sell those shares and potentially realize losses on your balance sheet as opposed to gains to ultimately trim those positions. But ultimately having an annual process to evaluate those newly vested positions, because now they are yours. And you can do what you choose. You can decide to sell them, you can hold them, you can sell them at a future date, you can gift them to charity, you can do many, many things to them. So review those on an annual basis. The second thing I would recommend you do is tax loss harvesting. Okay, implement a tax loss harvesting strategy if you have a taxable brokerage account. For those of you that are familiar with this one, when you are investing in positions, whether it's individual stocks or exchange traded funds or mutual funds, over time, you're going to have most likely, hopefully, some gains in those positions. Okay, but sometimes if you're adding money on a frequent basis, every 5 years we have some sort of pullback. We have some sort of bear market. Maybe there's some, like we've experienced so far in 2025. You may have some temporary losses that are just paper losses, that you have not realized anything. You haven't sold anything to create a tax loss yet. So what you could do is you could go ahead and sell those positions potentially at a loss and use those losses essentially as, as dry powder to either reduce capital gains in the current year. So if you were doing some, maybe, you went in this annual process number one and you said, hey, you know what, here's some positions I want to go ahead and sell. Maybe you have some other positions over here that are temporarily down in value that you could sell and completely wipe out that tax gain from that company stock that you are selling. Okay, so over time, and if you don't have any of that capital gain liability in the current year, over time you can build up this war chest on your tax return, so to speak, and offset losses in the future. So begin to do the tax loss harvesting strategy early and often. Build up that war chest of carry forward losses on your tax return that you can go ahead and offset some of those capital gains that you're going to be realizing at some point in time when you go ahead and sell those concentrated stock positions. And the number three thing I would recommend you take a look at is if you are charitably inclined, consider using some of these newly vested stock units as part of your charitable giving strategy. Okay, so as these stocks appreciate, better yet, if they've appreciated longer than 12 months in your balance sheet, now they're long-term capital gains. Now you can go ahead and gift some of those restricted stock units that are vested on your balance sheet. You can go ahead and give them to your favorite charity. Again, if you are charitably inclined, and that charity is going to receive the fair market value of those shares, and you're going to get a full deduction up to 30% of your adjusted gross income. You're going to get a full tax deduction in the year you gave it to that charity. And all by the way, you did not pay any taxes on those gains in the position. So let's say maybe they issued some shares to you and they were worth $50,000. Now they appreciated to $60,000. Where normally, if you would sell this, you would have an LTCG, a long-term capital gain, and you would pay capital gains taxes on this. Whereas if you gave that $60,000 directly to a qualified 501c3, there is going to be no tax liability on your end. And of course, the charity, they don't pay taxes on their end. And then you're going to get a deduction for this $60,000. Okay, and it is limited to 30% of your adjusted gross income. So if you can't use the full deduction in the first year, you can carry those forward up to 5 years, I believe. Okay, but really looking at these charitable donations, and even if you don't have a charity in mind today, maybe you're like, hey, you know what? I'd love to give to charity at some point in time, but I haven't really picked out my favorite charity yet. Consider using a donor advised fund. Consider using the DAF strategy and contribute to the donor advised fund. It acts just like from a tax perspective, it acts just like giving directly to a 501c3 organization, but now the money is inside of the donor advised fund, and you can go ahead and liquidate those positions, rebalance the portfolio without any tax implications, and now you can begin your charitable giving process whenever you are ready. Maybe it's 5 years from now or 10 years from now. And over time, you can allow that portfolio to continue to grow within that donor advised fund based on the securities that you picked within that account. So again, big time potential benefit if you are charitably inclined. And again, listen, as an entrepreneur myself, I 100% see the value, okay? But it's very important to understand that if you're an employee at a large corporation, there are things that are going on behind the scenes that you may not be privy to, okay? And so even if you are very bullish on the company you're working for, it's a good idea to have an ongoing process to make sure you don't run into the same situation that this client ran into. But would love to hear from you. What would you do if you were this client? Are you going to take the conservative strategy? Are you going to do the moderate strategy, aggressive, or something totally different? We'd love to hear from you. Just comment below on the video. I'd love to hear your thoughts. And also make sure to share this with someone you know who works for a publicly traded company. It might have a significant portion of their net worth tied up in that particular company's stock. I know they would find value in hearing the same content. But that's it for today, everybody. I hope you found it helpful. And again, thank you for your support, and I will see you all next week.